All right. Good morning, everybody. Thanks for joining us today for our fourth quarter webinar here at Black Diamond. Today, I'm joined by our fantastic mergers and acquisition team, and we thought we'd spend a few minutes going over some of the trends that we've seen in 2023 when it comes to deal making, and then we're going to try to get our crystal ball out here for a few minutes and give you some insight into what might happen in 2024 from our vantage point. Of course, we could be completely wrong, but we do see some indicators in the market that we'd like to share with you. We're going to spend about 30 minutes going over some content this morning, and then we always allow about 15 minutes or so for some Q&A. If you have any questions that you'd like to ask when we get to the 11:30 mark, you're feel free to ask those questions. And there's a chat function also where you can submit your questions, and then we can address them at that time as well. So thanks again for joining us. We hope everybody's having a great day today, and we'll go ahead and get started. First, in the way of introductions, I'm joined here on my right by Lane Off. Lane is one of our mergers and acquisitions leaders. He's been with us for how long now?
About 2.5 years.
Okay, 2.5 years. Got a good bit of deal experience working deals in Arkansas and Texas and California, some other spots too that we've been fortunate to help owners with. On my left right here, this is Chase Piotrowski. Yep. Chase is more recent to our team. He's a finance grad from TCU. We're really fortunate to have him on our team, and he does a lot of our associate and analytical work when it comes to financial modeling and financial spreads, and he's a really integral part of our team. To his left is Andy Riethmeyer. Andy is one of our mergers and acquisitions leaders as well, alongside Lane. Andy's got a great breadth of experience in different industries, had retired once already, been successful, and decided that he needed to go back to work for a little bit. And so he's been a great addition to our team, helping us navigate different deal waters in terms of asset deals and stock deals and things like that. So we're fortunate to have Andy as a part of our team here as well. My name's Christian. I'm the managing director here at Black Diamond, and just really love coming to work every day, working with these guys in our broader team. Okay, so let's talk about 2023. It's hard for me to believe that it's almost over, right? It's crazy. It seems like we were just getting this year started for the most part, but some of the things we've seen in our deals here have been, well, banks are moving kind of slow, right, guys? And they're taking longer to make decisions. Seems like underwriting is sometimes more of a challenge. And frankly, we're seeing good deals get turned down by banks, and they're asking for additional sources of either equity in from the borrower side or maybe more seller financing than we've seen in some transactions. So in some of the deals that you guys have been working, what are some key things that you've seen? Lane, we'll start with you.
Yeah, I think a lot of things have been different in 2023 compared to 2021 and 2022 that we hadn't seen in quite some time. And I think with certain deals that we've been working here at Black Diamond, I think the opportunity for private investment, private credit, I think those got more opportunity this year than maybe in previous years with the increase in tightening and lending on the commercial side. And like Christian said, I think some of these deals are getting a little bit more creative, some additional seller financing. And I think we've seen a little bit more of earnout components being added to deals to help them get across the finish line.
Yeah, about 5 years ago, it was extremely rare to have a deal that had an earnout component in it. And this year, not all of them, but a good number of them have had earnout components in them. And so there's definitely been not just a rise in interest rates, but a shift in risk from not just all in the borrower anymore, but we're seeing, shared risk to some degree on the sellers as well. So what about you guys? What have you seen this year?
Well, from my perspective, I will echo what Lane said about the financing. It's oftentimes you're having to go back to secure financing more than once. So the initial party may drop out, or you may have to go back to the well to really get the financing you're looking for. It's taken a little bit more time to complete a sale than it has in the past. So I think the time element is there, and just the ability to be mobile and secure financing and do a little more search there. I think one of the things going forward that is going to pick up is the buy side engagement. These companies looking for strategic purchases that will fuel their growth coming out of COVID, coming out of this economy. So I do expect for the coming year to see more activity and buy-side activity. So
Any particular industries that you think might be better than others and when it comes to buy side activity?
well, one of the industry that I'm researching into is distribution, and because there aren't that many small distributors to start with, and so I do expect to see more mergers inside that distribution channel, and I do think that it'll be a strategic merger with companies that give you an opportunity to decrease cost and also increase customers that you serve and take money to the bottom line.
It's interesting because in 21 and 22, we kind of saw this run up, especially at the end of 2022, we saw this run up of deal activity. And I think a lot of that was people anticipating interest rates increasing. And then it seems to have bottomed out a little bit, first quarter, second quarter of 2023. Overall, I believe the metric is, the overall deal volume across the board in the United States was down about 14% in 2023. But the staggering statistic is that if you look at the aggregate value, it was down over 40% of historical norms. And so we kind of saw this major intersection when rates went up. We saw values get compressed a little bit. And not so much now, but I'd say probably 12 months ago, as we were looking at going into 2023, I know we were having lots of conversations with business owners that didn't quite understand why their business might not be worth as much as it was 2 years ago if it still had the same performance. And so you really have to, we spend a lot of time educating business owners on, debt service coverage ratios and things like that, because when rates go up, it's harder to make that bank payment. And so, and not only that, but banks were looking for higher coverage ratios. Some were higher than we'd ever seen before. And so, those are things that all come together to impact a deal getting done between two parties. And so that is what led into this creative financing, where, okay, the bank's going to do a certain amount, right? And then we got to get seller financing and or earn-outs and other creative mechanisms to try to pull it together so that it works for everybody. So, Chase, what are your thoughts on any of that?
Yeah, just, in my short time here, I've been seeing a lot of things as well that this team has echoed, and really, it's been interesting to see how we have to get creative and educate both the buyers and sellers on some of the benefits that can be included with seller financing and earn-out to really help get a deal towards the finish line.
For sure. Well, are there any good stories you guys have from some of the deals that you've been working on this year? When you sit around the Christmas tree with your family in a couple weeks and grandpa and grandma, I mean, not for you, Andy, but when your grandkids ask you, hey, what have you been working on? Happy at work, or what are some of the stories that are going to come to mind?
There's quite a lot. Got me processing.
This was unrehearsed, by the way.
This is the unrehearsed part. I mean, we could go into the plenty of maybe more fun parts that are not some interest rate deal related aspects of these, but as we see, but I can't off the top of my head. Do you have any come to mind, Andy?
I think the challenging thing this past year and coming into next year is going to require is that companies become very creative at how they approach these deals. And I think you have to be patient, you have to have creativity, and you also have to have persistence, because there are three parties involved and sometimes more than that. You've got buyers, you got sellers, and then banks and financiers. So all of those interests may be a little different, and trying to find ways to merge all those interests into one and trying to get a deal done can be challenging. You just have to be persistent with it, and you have to sometimes just re-engineer your deal. If it doesn't go through the first time, let's see what we can do to address some of the issues to get it back on the table. So,
yeah, you brought up a bunch of good points there. I mean, the capital stack in general, is more complicated now maybe than it used to be. And so where 2 years ago, a normal commercial bank might just look at a deal and say, yeah, this makes sense. We're going to go ahead and approve it. Now, they may want to be the lead on it, but they're going to go get a mezz lender to come in behind them and do some bridge financing. And then you've got these other components. And so that's what can lead to okay, be patient, but also be persistent and be willing to be a little bit flexible to make sure that you can get a deal done. What really we love to do is to go find the right parties to do a deal, right? To make sure that culture is going to match and that this transition can be one that can be just long lasting and be part of their legacy. So when we find the right people, we feel like, okay, we know now, we feel very confident about how this company can move forward, putting the pieces together with all these other groups you're talking about, right? The financing and whatnot, and the deal lawyers and the accountants and everyone that ends up getting involved in some of these transactions, really just helping make sure that everybody sort of stays on track, right? And all these other external factors really are ones that we can work through. I mean, this is really the first year we've seen rates over 10% in some cases, right? Except for mezz rates, of course, but I mean, you start standard commercial interest rates. And that puts a lot of debt pressure on a highly leveraged transaction, right? So, modeling is even more important at that point, and where the risk factors are in the deal, both pre-closing and then after closing, become even more critical to making sure that everybody's on the same page and that the lenders are getting what they need in terms of their covenants and what they require. So it makes it a little harder, but again, once we kind of have the right team in place, we feel like, hey, it's worth it in the long run, right? For sure. Okay. Andy, let's go back to you. So get your crystal ball out. What's going to happen in 2024? What are your thoughts on that?
The things that I would encourage business owners to do is pay particular attention to key performance indicators, to operate your business as efficiently as you can, because there are going to be opportunities in whatever economies that we have next year. Every economy creates a series of opportunities unique to that economy. I think buy-side activity is going to pick up. If I'm right, then that's strategic purchasing. And I think, to pay attention to your key performance indicators so that you position your business to take advantage of growth opportunities where they are available and where they make sense for you is going to be vitally important the next year.
Yeah. Good thoughts.
Yeah.
Chase, what about you?
I think in addition to that, we probably will see some changes in some interest rates and things like that. We've kind of started to see a slow in the increase and kind of hoping leveling off of those interest rates, which should help both buyers and sellers get more comfortable with where the current market is at, with that stabilization and hopefully a decrease in rates to make lending a little bit easier. Everyone will kind of get more comfortable and get better understanding of where the market is, where their business is, and hopefully kind of get people more comfortable with the deal process and moving forward on some of those.
Yeah, I think 2024 is going to be a fun year ahead of us. I think we got a lot of big things that we'll touch on here in a minute. Like Chase mentioned, we have a lot of unknowns in rates. I know the Fed chair this morning said it's a little premature to talk about rate cuts, but I think most bigger banks and bigger things we're seeing, they're indicating a future drop in them later down the year. But we also have an election coming this next year, and that has an effect on deal activity as well. When there's a lot of unknowns on where the policies and parties of the country will be at, I think that on M&A activity, there's just a bit of unknown. So I think in terms of next year, as you mentioned, we had a little bit of a bottom out in deal flow that has seen more of an uptick as of end of this year compared to the beginning of this year. And hopefully, we're seeing a ride of that into 2024 and hopefully a little bit more, maybe it's a cautiously optimistic run into 2024 on M&A side.
Yeah, from our perspective, which is just a little microcosm of the whole, industry, we didn't really see things quote unquote slow down or really take longer until really the midpoint of 23, because a lot of the things we were working the first half of 23 were deals that were that were started at the end of 22 or whatever. And so it took about 6 months, I think, for us to really start to see a big impact on buyers not being able to get normal financing done and things like that. So we were starting to be, all these headwinds, right, that were coming at us. So I think that, it's not just magically going to change on January 1st, in a couple of weeks. It's not just like they're going to flip a switch or something and everything's going to be, easier and rates are going to automatically come down overnight. So I think that, when we're talking to lenders and people that are in the know and other business owners and that sort of thing, this could drag on for a little while longer, but I also think that, to your point, Chase, more than likely we are going to see some rate reduction. I do feel like that, but then I would also prepare for a little bit of a bump, maybe. Like, so what I mean by that is, if rates decrease, then a bunch of people that have been sitting on the sideline are going to jump to try to buy whatever's out there that fits their business, their strategic plan. So if it's manufacturing, right, they're kind of waiting on that to get a better debt service coverage ratio. Well, you got to keep in mind, how many other buyers am I competing with in that space, which is why the buy side activity has picked up. To your point, historically, we do about 25% buy side work and 75% sell side work. But right now we're already probably a third buy side with some of our clients. So we've seen some of that too. However, if rates do go down, I would also plan for the fact that they may go back up a little bit after that. And so what does that mean? So if that were to happen, what do you think might happen in some of these industries? If I want to take a stab at that.
Well,
Go ahead, Blaine.
no, I was gonna say, it depends on the type of financing someone does in a deal that may have an effect on more than the industry. I mean, if someone goes, all cash and, out of pocket, maybe a strategic buyer, they're gonna have a little less risk on the interest rate side. They might see more of how's the industry playing as a whole to them and can that grow the, business more. But if someone goes and does traditional commercial financing, depending on the loan there, they might have some adjustable rates that have an effect on that bump up and bump down of rates if there's a downward trend and an upward trend back up that you mentioned. So I think industry wise, it's a lot of them, your tax, your goods, they're more stable and this type of environment. But you might see with the housing market having a slight slowdown as it has been of what people are saying, you might see some construction and related industries to that have some potential setbacks for a short period.
Those are good points, and I want you to also remember that no matter what happens with interest rates, the system just doesn't stop. It may slow down a little bit, but it's going to continue. Deals get done when interest rates are high, they get done when interest rates are low. And so we'll always have a market there. Valuations will be affected a little bit when market rates go up. But I think what we're saying is that, deals will still get done and we'll find ways to do it. And I think it'll be a little challenging in some ways, but we'll find ways to achieve them and we'll get the deals done.
Are there some industries that you guys can think of that are going to be less impacted by these rate fluctuations moving forward in terms of, when you're talking to private equity groups and things like that? I mean, what are their strategic plans looking forward into next year and beyond?
A lot of the ones we've talked to, like primarily two things, and that's, service-based industries, home services, facility services, a lot of those that have repetitive customers and different things. And the other side is more recurring revenue, your tech company, your SaaS company that has a recurring side. They're finding those two business models and, the industries that follow those, whether it's, HVAC or plumbing or, technology-based business. Those have less risk to them because they can project out their cash flow a lot better than, a construction business that, is trying to figure out deal volume and, available land, et cetera.
Right. Yeah. Yeah. It's funny because the ones that are, I guess, more consistent revenue, and then whether that's, like you said, home services, commercial services, healthcare is another one that probably won't see much. I mean, they won't see any sort of slowdown next year because groups are still looking for those good cash flows. And another one that is kind of interesting is this new AI, right? Artificial intelligence. What, if anything, do you guys think about where this is headed and how does that impact potential deals?
It's kind of crazy the things it can do. And I think every week there's a new platform coming out with a new technology. I mean, we heard stories of people, testing out AI alongside their legal review to draft initial documents.
That's scary.
Which is really scary. But of course, there was legal review, but people have been testing that, kind of testing the waters to see what it looks like. And of course, that shows you what else can they do in the process. And though it can streamline things and do other things, it's kind of scary to think about too, that it has the ability to do all this. So I think it has a strong impact on business and can have a good function, but there's still something that's great about a human touch to business.
Yeah, if you just do a quick search on, projected M&A trends, it used to be, it still is to some degree, technology is always sort of a buzzword that's out there. And then now it's like technology and AI, and it's almost like no one really knows where it's going to go. But everybody realizes it's sort of the next big thing in terms of technology. So it'll be interesting to see how that plays. And, there's a lot of funding going into different groups right now. So we'll just have to keep our eye on that market and see what happens if more private equity groups get involved and things like that. So, you can't go wrong with slow and steady growth. And so most of the private equity groups we deal with are really still in that fundamental United States core business. Like you said, a million EBITDA or more in these certain categories: manufacturing, distribution, healthcare. Good service-based recurring business models are going to still be very valuable, right? I mean, that's not going to change. And so I think one thing that I'm looking forward to personally is a lot of this cash that's been sitting on the sideline is going to be reinjected into the market as soon as rates go down. So, once they do tick down, it's going to be a big auction period for probably 120 days or so, I would say, right? To really try to figure out, okay, let's get some offers in on some deals and while we can lock them in. And then, we do expect to see more of a bit of a heavier rush there. Anything to add on to any of those topics? Okay, all right. Okay, have you thought of a good story yet?
All the different topics and come back to this.
Any good pointers for anybody out there in the audience today?
Any good pointers? I mean, we've covered a lot of things. I think it's going to be different for if you're a buyer or seller or just part of the overall economy. Just want to see where things go. I think never, and at least what we've seen is never, plan on something that hasn't happened yet. For people who are saying in news articles, hey, downturn here, upturn here, those things change every day. I think, as we talked about, core strong businesses find a way to survive, and deals, as you mentioned, Andy, they happen. So I think the key point is, finding the right times to deploy cash, make sure you're doing the right models and doing the right things and following your KPIs as a business.
Great points. I'm seeing more and more business owners that are realizing, I don't have to sell everything on day one. So we talked to a lot of business owners that say, hey, look, I know I kind of want to retire in 5 to 7 years. Let me go ahead and find my buyer now, and I'll just work for a little while. I mean, we're doing a deal right now where that's the case, and it's great to see because we can bring them together now, can do the transaction, and then they just work until they want to hang it up. Then there's not so much of a rush to close, get it done, and then they're moving on. And so there's this multiple stage process that usually works a lot better in terms of a larger transaction. Anything else you guys want to add to? Yeah.
I would say, with those owners being more willing to work and kind of find those buyers now, but not want to step away from the business until later, that really helps with the transition process and allows them to kind of see out their future plans for the company that they might not otherwise get to see if they stepped away right away. So it's really cool to see others reap the benefits of those situations.
100%. All right. Well, we're happy to open it up now to any questions that may be out there. If you would like, you can ask us those questions, or I think there's a chat function that you can use to type in the question if you'd like. We're happy to answer anything to the best of our ability. So. There are no questions right now. We didn't have, we either put everyone to sleep or
One or the other. Hopefully we did a great job.
yeah. Do you think the economy will be impacted by Charlie Munger's passing? I mean, I already missed it.
Yeah.
He was a great American,
Very
icon.
smart guy.
Oh,
Very, very intelligent.
Yeah.
Well,
It's gonna be sad when Warren.
I know, that's
passes.
the next one. Yeah. Oh, see now, you guys know.
I don't know, but I think he still eats McDonald's every morning for breakfast and
Yeah.
cherry Coke, so doing something right.
Something's going good.
Yeah.
So this one doesn't necessarily have to do with the trends, but it's someone who, what made you want to get into M&A? Like, what excites you about the?
Okay, so we have a question that's been sent into our production team. And the question is, what made you get into this industry of mergers and acquisitions? We'll start with you.
You want me to take that one? Okay.
Yeah.
Yeah, I mean, that's an interesting question. Thank you for that. You know, I've, as a business entrepreneur of over 20 years, and then being a CEO and a COO and running some businesses beyond that, I think it just gave me an interest in the process, the financial process of buying and selling. I had some practical experience in doing that. So I just had an interest in it. And I think another part for me too is a sincere interest in helping entrepreneurs. I think that that's a unique group of individuals. I think that we're risk takers, but we also tend to be able to serve in some areas. And I love working with entrepreneurs. I think that kind of led me to get involved in it. So.
Yeah, mine's a little different, just coming recently from an educational background and just finishing school. I really felt interested and in love with kind of the numbers side of things and understanding that everything has a value today and also in the future. So that really kind of struck a passion in me and led me to want to get into this field. And since I've been in it, it's also led me to really enjoy working with entrepreneurs. You know, these people create things from the ground up, and it's really cool to see them reach their goals and help them successfully transition to a new stage in their life as well.
Yeah, my journey's probably similar, a little to Chase, but we'll let you as well. Kind of grew up and worked for many years, and not so much the M&A before joining Black Diamond years ago, but kind of in an environment that had people doing activity and buying companies, selling companies. So kind of fell in love with the idea of, learning more about that. Felt it was a great aspect of business to learn. You get kind of, luckily we get the opportunity here to kind of get a touch into a lot of different industries without having to really work in them. So I think the knowledge base we could learn here is great. So, luckily got connected with the Black Diamond team and really enjoyed getting to meet a lot of great people over the years and help them realize their goals, whether it's buying or selling.
Thank you guys for that. My whole route here was like the most indirect way possible you could get into this. But the short summary is in 2012, I actually tried, as you guys know, I tried to buy a business back then, and it was so frustrating trying to figure out, what information to get, was it correct, and can anybody even explain it to you? And I just thought there's got to be a better way, and so that's sort of how Black Diamond was born. And we had our 10-year anniversary in 2023, so that was exciting, and look to keep it going and growing and helping as many other entrepreneurs as we can along the way. So thank you for that question. That was good.
This is specific for Andy. You had mentioned each economy creates specific opportunities. Is there a unique opportunity in distribution at this time, or is that just an area of interest for you?
No, I think there's a unique opportunity in distribution at this time. I think that there's, those people that are the larger guys have greater economies of scale. So I think the challenge is trying to group together strategic purchases in areas that you address those economies of scale. And so I do think specifically that distribution is an area that is going to pay you dividends to be bigger than smaller. And I think that we'll see more strategic acquisitions and mergers in that area. I think that will continue for the next decade or so. Did that answer your question, hopefully?
Here's one that just came in. I've heard you guys talk about an earnout. Could you just briefly explain what that is?
Yeah, an earnout is probably a component of a transaction. There's usually cash at close, or there could be a seller's note, which is, the seller taking on financing the deal as similar to a bank loan, but, through their side. But then there's also a third component of an earnout where part of the purchase price is paid out over the future, whether it's a year, 2 years, 3 years, whatever the time frame is. That's based off of certain metrics of the business. That could be customer retention, it could be performance based, revenue or profitability. There's a lot of different ways to tie it in, but it's a payout that is determined by performance of the business over time.
Yeah, it can be a good tool to negotiate a transaction where you can sometimes get into this cyclical argument, if you will, between buyer and seller. Well, the buyer needs the business to keep performing at certain levels, right? And then grow. And the seller, obviously wants it to be successful too after he or she steps away. And so, how can you make that best for both parties? Earnout can help in some situations where, especially if you we like to see earnouts tied to gross revenue where we can, because it's a little bit easier to track post-close from an accounting perspective. But yeah, like we said earlier, we are seeing more of those now than we used to in the past.
So revenue for Q1 and Q2 for a lot of companies kind of dipped. Do you guys see that staying the same, or do you see it going up, or kind of what are you seeing right now?
Question? Like that?
Yeah, from Q1, Q2 this year into next year. I think of course, it depends on the industry. I think we saw a lot of different businesses on all sides, whether it's with us or in the overall economy, to kind of take a smaller dip. Throughout this year, I think there was a lot of uncertainty. But I think we've seen a lot more of an uptick as of late on a lot of businesses over the last, call it 3 months. A lot of people are starting to perform a lot stronger than they were at the beginning of the year. And I think there's a lot more positive, more optimistic towards growth in the next year.
Yeah, I agree with that. I mean, if you think back to 12 months ago, we were having these conversations. There actually was quite a bit of uncertainty in the market, and people had already started to, pull back a little bit on some spending and things like that. And I think people now feel like, okay, we're either halfway through with this, or maybe even more optimistically, we're like 3/4 of the way through with this. Let's hurry up and get to 2025, right? Because that was always the thought was, hey, survive until 25. I can't believe how many times I heard that, survive until 25, right? So now we can start to hopefully see some things that are really going to be beneficial for all of the economy. But, at the end of the day, I mean, we can only control so much of what we can control. And business owners that we talk to are the same. They feel like, hey, I know my business well, I know our customers, and we're going to try to do what we can to support them and then not worry so much about these external factors. But of course they do come into play that we have to be aware of. So I think to that.
Well, I think that's good. It's a good analogy.
Wonder would say add nothing further. But
Keep it simple.
yeah. Yeah. All right, here's one. How high would you expect interest rates to go if they do keep increasing?
Nobody wants to pay.
Nobody- I think we want to internalize
The key word
it.
here- I think the key word there is if they continue to increase. I personally don't think they'll continue to increase. So,
Yeah.
I think that's
You know,
difficult to answer that question.
I mean, they've held steady for a couple meetings now. I think the consensus is that they'll stay steady again, but if they were to go up, I mean, I'd say few more rate hikes, maybe one or two would be for me is what I'm internally thinking, but I'm not a part of that, so.
yeah, I disagree with your assessment. Yeah, I mean, who knows, right? It's interesting because 2 years ago, our mezz rates, right, were really kind of in the 12 to 14% window. Okay, and now, we have regular rates that are over 10% in some cases. Prime plus two is over 10, so it's like, well, now the mezz rates have shifted, right? So now they're like 13 to 15 in some cases, right? And so your overall cost of capital has definitely increased, but yeah, hopefully we won't see a big increase. I don't think the Fed's looking to do that. I think that they're closely monitoring the different metrics that they look at. And I'd say two things. If you have cash and you're waiting on a deal, as soon as they go the other way, just expect for an auction, because you'd be better off to go ahead and start the process of buying a business now than waiting on that, because it's going to drive prices up temporarily. And so right now you kind of have your pick of different things. If you're a buyer, right, in certain industries, you want to start that process while everyone else is waiting. It's a great opportunity, like Andy said, to go ahead and start now. Because by the time you get to the closing table, chances are rates may have come down a little bit, right into that being in your favor. So you win in two ways: lower rates potentially, and also the prices are going to be more in line with what your expectations would be, and not be driven up by some sort of third-party auction in that scenario. All right, so last call for questions. Anything else out there? Well, thank you guys for your time today. Thank you for joining us out there. We do record these, and so this will be sent out. If you want to go back and watch it or share it with a colleague, then you're free to do that. Again, we do these 4 times a year usually, and love having different guests and whatnot. So everyone out there, have a safe and Merry Christmas and a Happy New Year. You know where to find us if you need us to help you put a deal together, buy, sell, or whatever the case may be. We're here to help in any way we can.